In financial mathematics, the implied volatility of an option contract is that value of the volatility of the underlying instrument which, when input in an option pricing model, will return a theoretical value equal to the current market price of the option. A non-option financial instrument that has embedded optionality, such as an interest rate cap, can also have an implied volatility. Implied volatility, a forward-looking and subjective measure, differs from historical volatility because the latter is calculated from known past returns of a security. Motivation, an option pricing model, such as Scholes, uses a variety of inputs to derive a theoretical value for an option. Inputs to pricing models vary depending on the type of option being priced and the pricing model used. However, in general, the value of an option depends on an estimate of the future realized price volatility, I-florin, of the underlying. Or, mathematically, where C is the theoretical value of an option, and F is a pricing model that depends on I-florin, along with other inputs. The function F is monotonically increasing in I-florin, meaning that a higher value for volatility results in a higher theoretical value of the option. Conversely, by the inverse function theorem, there can be at most one value for I-florin that, when applied as an input to, will result in a particular value for C. Put in other terms, assume that there is some inverse function G equals phi1, such that where is the market price for an option? The value is the volatility implied by the market price, or the implied volatility. In general, it is not possible to give a closed-form formula for implied volatility in terms of call price. However, in some cases it is possible to give an asymptotic expansion of implied volatility in terms of call price. Example, a European call option, on 100 shares of non-dividend paying XYZ Corporation. The option is struck at $50 and expires in 32 days. The risk-free interest rate is 5%. XYZ stock is currently trading at $51.25 and the current market price of is $2. Using a standard Scholes pricing model, the volatility implied by the market price is 18.7%, or. To verify, we apply the implied volatility back into the pricing model, F, and we generate a theoretical value of $2.0004. Which confirms our computation of the market implied volatility. Solving the inverse pricing model function, in general, a pricing model function, f, does not have a closed-form solution for its inverse, g. Instead, a root-finding technique is used to solve the equation. While there are many techniques for finding roots, two of the most commonly used are Newton's method and Brent's method. Because options prices can move very quickly, it is often important to use the most efficient method when calculating implied volatilities. Newton's method provides rapid convergence. However, it requires the first partial derivative of the option's theoretical value with respect to volatility. That is, which is also known as Vega. If the pricing model function yields a closed-form solution for Vega, which is the case for Scholes model, then Newton's method can be more efficient. However, for most practical pricing models, such as a binomial model, this is not the case and Vega must be derived numerically. When forced to solve for Vega numerically, one can use the Christopher and Sorkin method or, for more accurate calculation of out-of-the-money implied volatilities, one can use the Corrado-Miller model. Implied volatility is measure of relative value, as stated by Brian Byrne. The implied volatility of an option is a more useful measure of the option's relative value than its price. The reason is that the price of an option depends most directly on the price of its underlying asset. If an option is held as part of a delta-neutral portfolio, then the next most important factor in determining the value of the option will be its implied volatility. Implied volatility is so important that options are often quoted in terms of volatility rather than price, particularly between professional traders. Example, a call option is trading at $1.50 with the underlying trading at $42.05. The implied volatility of the option is determined to be 18.0%. A short time later, the option is trading at $2.10 with the underlying at $43.34, yielding an implied volatility of 17.2%. Even though the options price is higher at the second measurement, it is still considered cheaper based on volatility. The reason is that the underlying needed to hedge the call option can be sold for a higher price. Implied volatility as a price. Another way to look at implied volatility is to think of it as a price, not as a measure of future stock moves. In this view, it simply is a more convenient way to communicate option prices than currency. Prices are different in nature from statistical quantities. One can estimate volatility of future underlying returns using any of a large number of estimation methods. However, the number one gets is not a price. A price requires two counterparties, a buyer and a seller. Prices are determined by supply and demand. Statistical estimates depend on the time series and the mathematical structure of the model used. It is a mistake to confuse a price, which implies a transaction, with the result of a statistical estimation, which is merely what comes out of a calculation. Implied volatilities are prices, they have been derived from actual transactions. Seen in this light, it should not be surprising that implied volatilities might not conform to what a particular statistical model would predict. Non-constant implied volatility, in general, options based on the same underlying but with different strike values and expiration times will yield different implied volatilities. This is generally viewed as evidence that an underlying's volatility is not constant but instead depends on factors such as the price level of the underlying's recent price variance, and the passage of time. There exist few known parameterization of the volatility surface as well as their de-arbitraging methodologies. See stochastic volatility and volatility smile for more information. Volatility instruments. Volatility instruments are financial instruments that track the value of implied volatility of other derivative securities. For instance, the CBOE Volatility Index is calculated from a weighted average of implied volatilities of various options on the S&P 500 index. There are also other commonly referenced volatility indices such as the VXN index, the QQV, IVX, Implied Volatility Index, as well as options and futures derivatives based directly on these volatility indices themselves. See also, Forward Volatility, GSVI, Notes. References, Beckers, S., Standard Deviations Implied in Option Prices as Predictors of Future Stock Price Variability, Journal of Banking and Finance 5, 363-381, doi, 10.1016/0378-4266, 81, 90032-7, retrieved 2009-07-07 Mayhew, S., Implied Volatility, Financial Analysts Journal 51, 8-20, doi, 10.2469/Farge v51n 4.1916a. Corrado, C.J. Su, T. Implied Volatility Skews and Stock Index Skewness and Kurtosis Implied by S., The Journal of Derivatives, retrieved 2009-07-07 Greenspan, C. A Note on the Equivalence Between the Normal and the Log-Normal Implied Volatility, A Model-Free Approach, Preprinter, Greenspan, C. Asymptotics Expansions for the Implied Log-Normal Volatility in a Model-Free Approach, Preprinter, External Links. Computer Implementations, Real-Time Calculator of Implied Volatilities when the Underlying Follows a Mean Reverting Geometric Brownian Motion, by Razvan Pascale, University of Alabama, Implied Volatility Calculation by Serda Senator Test Online Implied Volatility Calculation by Christophe Rougo, ESILV, VBA and Excel Spreadsheet to calculate implied volatility with the bisection method.